Hey everyone, Dalton Grados here for our weekly newsletter heading into June 2nd. So we are in a new month. Um, and what we're going to do, how we're going to structure this is first I'm going to talk about our technical levels for the day traders heading into this week. And then I'm going to go over economic events, earnings, and talk a little bit about this bond, what's happening in the bond markets, which has been in recent news economically and what that could mean. So we're kind of start zoomed in and focus on the day trading, and then we're going to zoom out and be more holistic and understand more about what we're looking for in the economy and economic events and earnings and everything like that. So let's first start with our levels. I'm on the S&P futures, and on the daily chart, immediately what I see zooming in is this range that we've been maintaining on the daily. So roughly from 57.38 up to 6,000. Maybe you could call it this, if you want to be more precise, top of this wick, 60.11. Market has been really in this range and even maintaining a tighter range. If you look at the bodies of this candles from, say, 5800s to you could call it, yeah, 6,000, right? Nice round number up there. 5990s, right? Close to 6,000. We've been in this tighter range, and the market has sort of faked out buyers below and faked out the sellers above to grab that liquidity and then come back into range. So immediately when I'm looking at this market heading into this week, I'm looking at this range, whether we're just going to play the range, as short-term traders, if we play the top of the range, the bottom of the range, and then if we get a break of this range back down below. This is a nice gap fill here, which we have filled. It looks like, well, not exactly. So we could fill this gap down here to the 5700s. And let's see, if we want to be more precise, 5713 would be the gap fill down there. So again, maintaining this range or breaking below. Our first target below, if we break, so precisely, let me be more precise here, if we break this low here, which would be 57.60, 57.59. Precisely, if we break that low there, then we'd be looking to fill the gap here. I'm going to clean this up and remove this line. Fill the gap here to 57.13. You could call it 5700 if you want to be more round numbers. That would be the first target below. If we start to head down, what's the next target below that? I would say this is a big support here, 5600. In past newsletters, we have talked about that level as being a big level of support. We had it for here. We had the support here. When we had this venture down and break back above, that was the level we had to hold, 5600, to continue on up. So should we get a break of the 5760 level, we should target this gap fill, and then next level below that, 5600. To the upside, if we break above this range, 6,000, and then precisely this high here, 6,011, we should target up here. All we're doing is looking left. So 6,200s is our ultimate target up there, with 5,100 being in the middle of range. We're not overcomplicating this, right? So to the upside, we break to the upside. 6,100 is our first target. That's the middle of range. And then the top of the previous range, 6,200, which would lead us really to all-time highs. So above that, we have our all-time highs, and that would be, roughly the 6250s would be the next target above there, and 6300s would be the next target above there. All right, so that's what we're looking for in terms of our levels heading into this week. Not that complicated. We have a range. Are we going to maintain the range? The good news is, looking at this, it looks like we've already faked out people on both sides of the range. So what we're really looking for now is a break of those wicks. Those wicks should hold, and if they don't, then we should see a continued movement in either direction. If we break below, again here, or above there. All right. Now, heading into the smaller time frame charts, if I'm looking at trading on Monday and Tuesday of next week, let's go ahead and mark our levels there. So again, we've got our higher time frame. We're moving into our intraday time frame. Immediately for Monday and Tuesday's trades, I want to see 58.80 is an area that we'd want to hold support below. And then ultimately, these lows down here at 58.50 would be areas of support that I'm looking at. These should be relevant for at least the first half of next week. Obviously, we'll see what happens in the market, but just heading on to a smaller time frame. And then simple ranges here. 59.20 is sort of the top of this range here, and the bottom of this range over here. You see that? So 59.20 is another level. If we were to venture above that, we should be targeting these highs here. And then we have a long ways we can run. We would first target this area here that held 59.50. And then onward up to the bottom of this range and the top of this range. So again, we're marking our levels based off of ranges, right? So we have, this support here, this bottom of this range should hold. This fake out bottom here, that should hold. If it doesn't, then we know what to do. We know we're heading down. Top of this range should hold. The top of this range should hold. This top of range should hold for resistances. If we're breaking through them, then we know we should be continuing and we should be targeting them sequentially. So if we're breaking these levels, we should target this level, where the market should move from level to level. If we're breaking above these highs here, the 59.32s, then we should be targeting the next logical move up would be here. Breaking above here, the next logical move up is the bottom of this range, next logical move. So that's all we're doing when we're marking levels, is just figuring out if the market is going to violate these levels, where's the next logical place it should target. All right. So hopefully that makes sense. Maybe leave some comments below if you want any clarification, or if you have confusion, or if you want to tell me I'm totally wrong and not seeing the market right. Leave comments there. But we're going to move on now to our economic events. So looking forward to the rest of this week. We have first thing Monday, June 2nd, we have 10 a.m. ISM Manufacturing PMI. What is this? So this is basically the Purchasing Managers Index. That's what PMI stands for. And it's essentially how much these big manufacturers are purchasing from suppliers. It's a leading indicator of economic health. And so all you really need to know here is above 50 indicates industry expansion. Below indicates contraction. So this is an economic indicator. How is the labor market and the economy doing? Are we purchasing are we putting in big orders from our suppliers? Now you see the last readings have been below 50, which indicates economic contraction, which could mean, if obviously when we're looking here, this data comes out all the time, at least every month. January, February, March, April, May. Now we have June. So every month this comes out, and each entry is just one data point amongst many. So we want to look at the overall trend here when we're talking about economic forecasting. But if this, so you see, like the last reading, the forecast was 48. The actual was 48.7. So, from that perspective, the economy is not doing as bad as maybe we're anticipating. So we're holding up so far. Our next forecast is going to be up 49.3. So we want to see an improvement there. And if we are below, that just means that, okay, maybe the economy is not as strong as we're thought. But each one of these is just little data points. The main thing is the overall trend, which I've always said as far as what this means for the stock market, I maintain a position of bad news is good news. What I mean by that is that if the economy is doing worse, the Fed will be pressured more to act, and that means lowering rates, which would be good for the stock market. So we don't want to see people lose jobs for the good of humanity, right? We want to see a strong, healthy economy. But so that would mean that we want to see this PMI number holding strong, near 50 or above 50 ideally. But in terms of talking about the stock market, if we start to see the economy deteriorating through this economic data, that would mean that the Fed is pressured to lower rates. Again, good for the stock market. Okay, so that's Monday. We have Fed Powell speaking at 1 p.m., so it doesn't sound like an announcement or anything. He's just probably doing a conference. And then JOLTS job openings. This is another economic indicator. So again, with the JOLTS, we want to see, what are the job openings looking like? Job creation, important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So again, we're just kind of zooming out here, looking at the overall economy. We're done talking about day trading at this point. We have Wednesday, non-farm employment change. So same thing, economic indicator. We're just going to see what is our employment looking like. And then let's see, ISM Services PMI. So similar to the manufacturing PMI, we have above 50 is industry expansion, below is contraction. And we've been holding above 50 here. So that's why we can't just, when we're looking at these indicators, we can't just look at one. Like, oh, manufacturing PMI is worse. Oh no, we're going into a recession. It's like, no. We have to look, there's services PMI, there's the job openings, there's on-farm employment change. There's all of these factors that are going to give a holistic picture of what the economy is doing. So it's not that one thing is going to cause the economy to tank. Services PMI is holding up strong. So that's an indicator of a healthy economy, which is good for long-term investment, but not good if you're trying to build the case for the Fed to lower rates. All right, Thursday morning, 8:30 a.m., unemployment claims, same thing. Are we seeing unemployment rise or are we seeing unemployment fall? The last reading, and again, these come in every week, so it's just one data point amongst many. Last one was a little bit higher than forecast, so we're just monitoring this data. And then Friday, so it's a big week actually for economic data. Friday we have the non-farm employment change, same thing. Same narrative here of if you're looking as a long-term investor, you obviously want to see a healthy economy. In the short term, again, our point about the Fed being forced to act. I think you get the picture there. So let's next look into our earnings. And I didn't really see much that was really significant other than CrowdStrike on Tuesday. I'm personally invested in CrowdStrike, so that'll be interesting to see. That's a big cybersecurity company. And then Thursday, Broadcom. That's a big $1 trillion market cap company. So Broadcom earnings could potentially have some swing in the NASDAQ, but none of your Apple, Amazons, Googles Tesla's, Nvidia's are reporting this week. So shouldn't see too much volatility related to earnings. And lastly, zooming out a bit more, I wanted to just briefly touch on the issues that are happening right now with the U.S. Treasury auction, and that sort of relates to this spending bill that has passed through Congress that would essentially increase the national deficit, which is really the opposite of what everyone wants to do to see America thrive. Is we've been wanting to cut spending, we've been wanting to reduce the deficit, and this new bill has proposed to increase the deficit. And we've seen in the Treasury auctions a lack of demand. So I'm just going to briefly touch on what this means. Basically, we had for when the government is issuing bonds, they're issuing debt. That is typically bought up by investors, and namely foreign governments that buy U.S. bonds. And so we had very, very low demand for our 20-year bond auction. So that's a long-term bond. And the yields rose because when there's low demand for a bond, you have to keep raising the rate to attract buyers. So we've talked about this before, about bonds and yields and the price of the inverse movement between yields and the prices of bonds. So just think about it though. If you have, say I offer you a bond and I say, hey, I'm going to pay you 4%. And you're like, no, I'm not going to take 4%. Well, if I got to get rid of my bond. So I'm like, okay, how's 4.5? And then I keep raising the yield. Oh, how's 5? So it ended up that the yields rose to 5.047%, around 1 basis point above where it had traded before the sale, to meet that lack of demand. So what does this really mean is that basically we're struggling to attract buyers for our U.S. debt, which means that this is the fancy CFA term for this is the intertemporal rate of substitution, which is just a very fancy term for meaning that investors will need more of an incentive to invest if they believe that the future doesn't look good, right? If the future looks good, then you need less of an incentive to invest, right? Think about a company. Think about whatever company you want to buy a stock in. If you think that company is going to do really great, then there's no barrier to entry, right? There's no barrier to say, oh, I want to buy into this company. Same thing with the U.S. government. If we think the U.S. government and the future of the U.S. is going to look great, then there would be a lower yield to our bonds to say, hey, we don't need much incentive to we really believe in the future of America. If we have to raise that incentive, that means that foreign governments around the world are not seeing confidence in our 20-year future for these 20-year bonds. Again, this is one data point amongst many. We take these things with a grain of salt as they happen because things can change all the time. But that's, in general, what's going on. So that could be a indication of a potential weakening economy, or at least the perception of a potential weakening economy. And back to the spending bill, it's being driven by the fact that we don't want to see, the world doesn't want to see a rising deficit for America. That doesn't look good for our balance sheet. And also we had a downgrade of our U.S. bonds. And I believe it's in this article somewhere. But it talks about that, the downgrade of our credit rating, right? So we don't want to take on more debt. Imagine trying to lend to someone who has a lower credit score. That's not good, right? So that's what's currently going on. I'd be continuing to keep an eye on this. If it's going to be tougher for the U.S. to attract buyers to its bonds, that's not good overall for the U.S. economy and the U.S. and the future. So take that for what it is. These things are ever evolving, ever changing, especially in the Trump administration where things change overnight. So, but I just wanted to touch on that again in this newsletter because we want to take a more holistic approach. So, we've talked about day trading, we've talked about economic events coming up for this week, earnings, and now kind of this macro perspective of things that are happening. And, what could it mean for the future? I'm not really sure. It's something to keep an eye on. But that, I think, will conclude this newsletter. So hopefully you enjoyed it. Give a like on this video, subscribe to the channel, and also subscribe to my free weekly newsletter if you haven't already. That just gets delivered to your email for free. There's no upsells or anything like that. But it ensures that whether I do the newsletter in a video like this or in a written form on Substack, that you will get that delivered to your email every week for our pre-market prep. And thank you guys for watching. I'll see you next time.